everyone. Thanks very much for coming tonight. My name's Gareth Powell. I head up the healthcare team at Polar Capital. Polar Capital is a small, mid-size asset manager based in London. Across the healthcare team, we run about $4 billion across different investment strategies, all long-only focused on healthcare and biotechnology. And the investment vehicle I'm going to talk about today is our investment trust, which is originally called the Polar Capital Global Healthcare Trust. So before dealing specifically with the trust, I'm just going to talk about the sector and where we're positioned from a stock market perspective. Now, obviously, I'm biased, but I think there's a very attractive opportunity here. So I'll try and convince you over a few slides of the story. So let me jump ahead. So just focusing on large mega-cap healthcare, and then I'll talk about small and mid-cap as a different opportunity. If you go back over decades, the two best returning areas of the market are healthcare and technology. Now, technology, I hope you all have investments in that sector. It's doing very well at the moment. Obviously, you've got the Magnificent Seven. You've got excitement around artificial intelligence. There's huge flows into technology. Investors are excited about it. Healthcare, I'm feeling very lonely. Nobody likes me. The sector's very much out of favor, which I think is the opportunity. And again, I'm going to try and convince you of that. So to reflect on what I said about long-term performance, the index on these graphs we have is the S&P 500 Healthcare Subindex. Absolute returns going back to 1989 have been really powerful, as I said. On the bottom chart here, we have the healthcare index run against the overall market, the S&P 500. And again, the trend's very positive, but you have times where the sector's in favor and the times when the sector's out of favor. And these seem to be 7-8 year cycles. You can see positive, negative, relative, positive. And over the last 7-8 years, since 2015, at the index level, we've struggled. The point we're making is hopefully there's a positive 7-8 year cycle coming, but we've come back to this upward sloping trend line, which we've only hit on a relative basis 7 times in 35 years. So we've had a pullback. Hopefully, again, it's an opportunity. So just reflecting on recent history, this is 2022 mainly. Healthcare performed really, really well. So if you remember the environment that everyone was worried about, you had high inflation, but you had investors very nervous about economic growth, so a real slowdown. So even though you had inflation going up, rates going up, which you'd expect to pressure high dividend stocks, pharma stocks, large cap healthcare, massively outperformed. So that's mega cap healthcare, this is large and mega cap, and this is the overall market in 22. So the key thing in 22 was stagflation, slowing growth. Healthcare works in large and mega cap when you have slower growth or recession. It's high quality, non-cyclical, some areas very defensive. But so in that environment, it was a big outperformer. Get to last year and healthcare was rubbish, sadly. The broader market, MSCI World, great return. Large cap healthcare here. Small return, light blue line is small mid-cap healthcare, bit better, but again below market. The reason healthcare lagged last year was economic growth surprised to the upside. So in the US, going into the year, economic growth was expected to be 2.3%. It finished the year at 3.5%, so healthcare lagged. Now we're seeing potentially an evening out of growth, maybe even a slight slowing. That should be supportive of healthcare on the margin. And if growth slows even further, we'll start to see flows in the sector. Now, this is my chart to show how in love we are, and hopefully this can change. So this goes back to 2013. That's just healthcare on the top relative to the market. This is the most powerful slide, I think, in the deck, and what I think is really good for market timing, and that's looking at ETF flows. So when ETF flows are super positive, you want to sell. When ETF flows are super negative, you want to buy. Right, so if I show you at the end of 22, look how high the ETF flows were in healthcare. So 2 standard deviations above the mean. Come to now, the opposite. So I think this is a really interesting point. I've showed you some of the long-term data and what's happened recently. ETF flows are flashing a contrarian buy signal for the sector. Another way of showing this is just looking at healthcare again, but looking at relative performance. So I said, obviously, last year healthcare struggled. What we have here is, on the bottom graph here, is rolling 5-year percentage change in relative performance. So healthcare, like I said, on the relative, peaked out in 2015. We had a rally in 22, dropped down in 23. We're right at the bottom decile of rolling 5-year changes. So again, just another indicator, hopefully, and hopefully you'll agree with me, that healthcare looks quite interesting from a contrarian point of view. And I'll come back to fundamentals to try and explain what I think are the drivers for better performance of the sector. Now, just quickly, small and mid caps. So in the investment trust, we have a small amount of exposure to small and mid cap stocks. We're mainly focused on large and mega cap, and again, I'll come to it. But small and mid caps have been awful last 3 years. So what I have here is going back to the end of 2020, large mega cap healthcare over that time. This is small mid cap healthcare, underperformance of about 50%, which has obviously been a bit of a nightmare. Healthcare small and mid cap is the most correlated sector out there to rates. Rates go up, small mid-cap healthcare goes down, and the reverse is true. So again, if rates are topping out, we're hopeful that this area of the market can do better. We think there's lots of opportunity. The main reason for that is this slide. So what we have here is the Russell 2000 healthcare index. So that's small and mid-cap healthcare in the US. So think sub 10 billion in market cap. We go back from 88, so we've got a really good history here. The valuation, as I said, is on price to sales. The light blue line is the relative valuation, and the, I don't know what color you'd call that, reddish, is absolute. So the point I want to make here is, in 2020 and 21, we were in an equity market bubble in some areas of the market, including some areas of small mid-cap healthcare, which matched the bubble of the early 2000s. Now, for small mid-cap healthcare, the valuation has collapsed. We've come down to really attractive levels on both relative and absolute. The same thing happened. I started investing in September 99, so this was a bit of a good time and then a very bad time. But where I feel we are now is similar to early 2003, where you saw a really big rally in small and mid-cap stocks. So hopefully it's the same, but valuation, we got down to 3 times sales in October last year. That's a very attractive level for the overall valuation level for small and mid-cap stocks in US healthcare. So that's sort of stock market stuff. Let me focus on the key drivers of why. So hopefully, again, I've shown you healthcare's out of favor. It looks attractive from a stock market perspective, but what we need for the sector to work is growth. And I think we can accelerate, and I'll show you the key drivers. So the first one, this shows the number of patients, and we can all relate to this, sadly, in the NHS over time. So essentially backlog or waiting list, etc. So we sort of stayed at a fairly steady level in terms of procedures. We had COVID, obviously demand collapsed, people weren't going to the hospital, and we've just exploded. So we're up to 8 million procedures in backlog. These procedures need to be dealt with. People talk about kind of care that you can decide if you want to have it or not, discretionary. A hip or a knee replacement that's needed, that hip and knee can get quite painful, and you do ultimately need to have the procedure. So we've got this enormous backlog, as well as, obviously, healthcare utilization collapsed during COVID, and we're only sort of on our way back to normal. So we've got this enormous backlog to deal with for the healthcare services around the world, which should be a positive growth driver for the sector. In terms of what's key, so that's a positive growth driver for the sector in terms of procedure growth. For 80% of our investment universe, these are product companies. They may be pharma companies, medtech companies, biotech companies. But what's key is new product cycles. If you don't have new product cycles, growth is anemic. Investors aren't interested. You have new product cycles, you get an acceleration of growth, and investors come into these stocks. So I'm sure you've all heard about the excitement around the new obesity products, which, sorry, I'll get used to this one day. Wegovy and Zepbound, which are all in the news, so they're growing fantastic rates. We've got this new medical device opportunity for atrial fibrillation, which is a very common problem to do with heart rate. Alzheimer's disease, we've had the first new product in a long time called Leqembi, which the efficacy is not amazing, but it's a new way of working and challenging Alzheimer's and supports hopefully a lot more research into the area. And lastly, just respiratory diseases. So COPD, kind of known as smoker's cough, we've got a new drug for that. And then also RSV, which is a viral condition where we've got antibodies and vaccines. So what's important, the takeaway from this, new products, new opportunities, new growth drivers that can drive revenue, earnings, and hopefully stock price performance with that. And then lastly, on the drivers, M&A. So healthcare is the most fragmented industry out there. So there's a long-term driver of consolidation as the industry becomes more efficient. What we are seeing is a real pickup in big pharma companies and big biotech companies trying to come in and buy smaller companies, and they're paying significant premiums because you have these small mid-cap stocks at discounted valuations. These big companies need new revenue growth drivers for the rest of the decade, so they're coming in and paying generally very big premiums to acquire these assets. So if we're fortunate and we invest in some of these smaller companies, then we can benefit, obviously, the portfolio from these takeouts. Long-term themes. So the most important growth drivers for healthcare, next 5 to 10 years are listed here. All very powerful, as I said, really long-term growth drivers. I've mentioned consolidation, innovation, you'd expect from us investing in this space. I just want to focus on emerging markets quickly because we think it's an exciting opportunity. So what we have here is a list of countries ordered by healthcare expenditure per capita. Sorry, you probably can't read the countries very well, but I'll highlight some. So as you can imagine, to the left you've got more developed markets, and then to the right you've got emerging markets. So the biggest spenders are the US and Switzerland. The UK is about here. And then at the other end is you've got China, Peru, Indonesia, and lastly India. Now, for us investing in developed market healthcare, it's all about making healthcare more cost-effective, more efficient, dealing with those procedure backlogs, technologies, drugs, medical devices to help that. In emerging markets, healthcare spending is just so low. We see a significant growth opportunity in those markets, and obviously we have opportunities to invest there. To give you a kind of sense of the extreme, the US spends 50 times more than India on healthcare. There has to be a kind of rejig on that. India needs to spend much more on healthcare. The US needs to control its spending. The big difference, you can't, again, sadly see it, is in India, 75 to 80% of healthcare spending is out of pocket. In the US and the UK, 75 to 80% is covered by either government care or health insurance. So you've got this significant shift that needs to happen, but we should see decades of strong growth in emerging markets on healthcare spending. So I'm just going to finish with some very quick comments on the portfolio, and then I'll finish for some questions. So the investment trust, growth portfolio, large mega cap focus on really high quality healthcare companies, 80 to 90% of the portfolio. Some stock names that we hold are listed there. The innovation portfolio, so that's really $5 billion companies and below. So the top sort of companies will be, hopefully less volatile. Again, obviously, hopefully will deliver some really good returns. The smaller mid-cap will tend to be a bit more, obviously, lively, but hopefully can bring even higher returns to the portfolio with the mix that we have. Current positioning, mega cap over 100 billion, 30%, large cap, 46%. So you can get a good feel of, obviously, that's the focus of the portfolio. US weighting is high, but sort of still below the index roughly. We have exposure to lots of other areas. India, you can see highlighted, Japan, and Europe, where we think stock market inefficiencies are more significant. And then just our subsector exposure, so biotech, big fans of, it fits with that M&A story. Healthcare utilization, we have exposure through healthcare equipment, supplies, facilities, and other areas. And then lastly, sort of at the bottom end of the spectrum, we have smaller exposure to things like services, distributors, and technology. And then lastly, just to finish, top 10 holdings overweight relative to our benchmark on the left here. Just some companies which you may recognize with, each individual story tends to be very different, which is good for diversification purposes. And then on the right-hand side, the top 10 underweights relative to benchmark. So what message, again, I want to get across on this slide is we try and invest with high conviction. We have about just over 40 holdings, high individual positions, trying to really generate relative outperformance for investors. So just to finish, and thanks for listening, and hopefully any questions, but we think the sector is out of favor. It looks attractive from a stock market perspective, from a contrarian point of view. We think there are really powerful fundamental drivers, and we're hopeful with the trust that we can deliver some decent investment returns from the sector. So thank you very much, and any questions?
If you have any questions, please raise your hand. Steve, right next to you, please. Thank you.
Good evening, thank you.
Sorry, sorry. Yes.
No, okay, continue, okay. Oh, sure.
Gentleman over here, please. Sorry.
Hi, yes. Looking at the graph, would you say that the share price is correlated with the S&P 5 or the NASDAQ? Because it sort of fell until November of this year, of last year. Yeah. Then it is risen in line with the sort of tech stocks. So is it correlated with the tech stocks, would you say?
So our benchmark is MSCI Healthcare, global, large and mega cap. Obviously, we're trying to deliver outperformance versus that benchmark. That benchmark has a beta of, I'm going to be slightly off here, but let's say about 0.6%. So the correlation's quite low, and it's that non-cyclical. Some stocks, pharma, defensive. So it's more cyclical areas of the market, like industrials, tech, will correlate more with the S&P 500. Healthcare tends to correlate differently. The other thing from an active management perspective is the great thing about healthcare, particularly product companies, is the stock-specific risk is so high. And because obviously if we can pick the right stocks, we can deliver returns on individual stocks. So with healthcare as an option, I think it delivers diversification because of a lower-ish correlation versus those market indices you highlight.
A question here then, please. Thank you.
Yeah, good evening. Thanks for the presentation. Could you just clarify what companies are in the life sciences and tools section? Is that through diagnostics, say genomics providers,
Yeah, so it's more on the, so Lonza is an example. So it's a contract manufacturer and developer of things like antibodies and proteins, really complex pharmaceutical products. So that's one example. Another example is Biorad, which will do things like diagnostics and life science tools and equipment and stuff, products. They're the sort of main two I'm currently thinking in the portfolio. So it's a kind of mix. We also have diagnostics companies in the portfolio, but they tend to come under healthcare supplies, so they're just classed differently.
Any other questions, please? Gentleman here, sorry, Chris. Just for a couple of rows.
Yes, I was very interested in the economic cycle you showed on the screen at the start of your presentation, about 7-8 year cycles. Do you see that as a very potentially valuable way to predict returns and to benefit from them for shareholders?
Yeah, it's a great question. And if it does work, it's amazing. I think, obviously the historical no guide to the future. I mean, there is rationale for the different periods. So, when we're underperforming, obviously earnings trends are important, but it's also what's happening to stock, multiples. So what we sometimes see is if there's a US election, there's concern about, and it's really if there's potential for a clean sweep with the Democrats coming into power because they'll take more government control. So obviously there's an election this year, we don't see that risk this year. But that's created, so if you go to the early 90s, a big derating, and also sort of around the 9-10 time frame. But they ultimately led to opportunities. So the sector's been out of favour. When Biden got elected, healthcare derated massively because there was worry there would be a blue wave in Congress in 2020. That obviously didn't happen, and then the sector's been up and down. But, there's rationale for those mini cycles. We'll have to see.
Just a question, to understand, why would there be a derating with the Democrat?
So if you think about it, the conventional thinking is the Democrats will come in, take more control, government control of healthcare, right, therefore limiting the free market, and their investors deem the opportunities more negative. But if you look at the last bull market for healthcare, it really started in 2008, but you had a sort of a dip, and then we had a really big run from, say, 2010-11 to 2015. That was the expansion in government access to healthcare through Obamacare, and actually the stocks did really well. So sometimes it actually doesn't sort of fit together, even though that's the perception. But generally, if there's risk on an election, you do get, for a year, this big derating. But if you look at the state of Congress, it's just not possible to have that kind of outcome this year, which is why, even though you have a US election this year, we're still pushing the sector.
There's a question at the back, I believe. Thank you.
Yes, thank you. What I'm hearing is that you're talking a lot about the index, the sector, healthcare, having potentially tailwinds. It's in a dip. It should bounce back, and it should have some pretty good years going forward. You said you benchmarked yourself against the MSCI Global Large Cap Healthcare. I'm curious as to know how you've performed relative to that benchmark.
Sure.
And the reason I'm asking is, if again, what I'm hearing is you're talking about the healthcare index a lot, but do you think there is actually the index might become less monolithic, and it might become more of a stock pickers environment, and therefore, the index itself might not actually, as a whole, might not be so rosy going forward?
Yeah, no, very good questions. I use the index just to illustrate, because we've got great charts of it going back a long time and the history of it. And the indexes definitely change a lot over time, which I think is part of your question. If I go back 20 years, so much of it was pharma, and now it's only low 40%. So it's changed dramatically. Also, as I sort of said earlier, the stock-specific risk is so high that you can make great returns on individual stocks. You don't have to have broad exposure to what's in the index. You can, and what we try and do is take these conviction bets. If you look at the life of the trust, so the first life was 7 years from 2010 June to 2017. That was really focused on a turnaround in pharma stocks. It was an income-focused vehicle. Pharma stocks were trading on very low multiples. They were massively out of favor. They had a really good run. The trust performed well at the beginning, but we grew the dividend and focused on that, so we actually lagged the index. And then since the transition in 2017, we became more of a sort of wider growth, multi-sector focus vehicle. There's still a dividend on the trust, but it's lower. And we've outperformed since we took that on. So it's called the restructuring and sort of another 7-year life. So healthcare is the best sector theoretically for active management because of that stock-specific risk. However, the hard bit is investing in the right stocks, right? In theory, it's the best sector for active management. So you hit me with a lot of questions there. Hopefully I've answered those okay.
I said one quickie. You talk about the stock-specific risk and the potential for the upside. How much access do you get? How much visibility do you have of the pipeline of drug development or equipment development for these portfolio holdings?
Yeah, so we've got a reasonably sized franchise in London, so we tend to get good management access. So companies, we're not competing for access in America, not competing in Europe or Asia, so we get companies coming through. So One company we invest in the different portfolios, the CEO we see the most, bizarrely, is actually a CEO of a hospital operating in India. But that's not really directly related to your question, but more the corporate access we get. So that we get management's view on that. We meet the key sort of like a biotech company, you'd meet the chief medical officer, the chief science officer, etc. And then we have a big team. There's eight of us with one advisor on top. We spend a lot of time looking into exactly that, following areas. So, we're currently looking at a company focused on eye care that potentially has a long-term treatment, which could be a sort of game changer in the space. We've got, I have Tara who works for me. She's focused on our sort of independent research. We use expert networks. So Tara was able to speak to a doctor last night who was an expert in the area. We had a call with company management today. Tara will hopefully speak to some more doctors. So we're able, with the kind of resources we've got, we spend a lot on research. Hopefully, the aim is with being specialist investors, we can find opportunities from doing work on exactly what you ask, and we can get into stocks, early before they outperform.
We've got one very, very quick one, please. Thank you.
My perception might be wonky, but in mid and small cap, the capital cycle tends to be aggressive and seems to have sort of more idiosyncratic kind of drivers. So after the 2008 crisis, it seemed there was a combination of excess cash to invest or need to invest, but also a significant kind of piecing together of different kind of knowledge in medicines and a lot of little biotechs and stuff made for quite a boom. Looking forward, what do you see driving a capital cycle boom in these kind of smaller mid-cap, but smaller biotechs?
Yeah, I mean, I don't... So if you recall that valuation chart on small mid-cap, the boom, there was a boom in 2000 to sort of 99, 2000. The next boom was in, obviously, 20 and 21, so 20 years. But there were sort of mini cycles within that. But ultimately, you're talking about bubbles, I think.
No, not really. Interest.
Oh, yeah. Okay. So they're extremes, right? Companies can raise money, very early stage companies. That's what we had in the 2020 to 21 timeframe. Lots of early stage companies, biotech listing, probably should have stayed private, access to capital. There was no real sort of, control over it, if you like. Now, if I reflect what you're asking, we've just seen some IPOs come back after a period where, for 2 years there's been nothing. So we're starting to see companies trying to come to market. Companies in good positions in small mid-cap land that are already public are able to raise capital. There are investors with capital wanting to invest in the sector. So if those companies list and they do well for investors, I think you may see a steady period of that. But what's absolutely critical is what happens with rates, because if financial conditions tighten again, that access to capital is going to go away again. So what's key is what happened with rates and then access to capital, and then it's the individual stories. So those companies that are later stage in assets with interesting products will be able to raise capital, but sort of companies with Me Too products with very early stage assets will really struggle because you're coming out of a bubble and it takes a while, it takes a long time to heal from that.
Thank you very much indeed. It's fantastic.
Thanks, everyone.
Thank you.